Heidrea for Heroes strives each day to give back to our deserving military veterans by assisting them through challenges and transitions in civilian life. A registered nonprofit organization based in Plymouth, we provide support services to veterans who need a helping hand from throughout southeastern Massachusetts. We offer a range of services including adaptive home renovations, vehicle modifications, specialized mobility equipment, qualified home repairs, and custom veteran and family support. If you or someone you know is a veteran in need of assistance, please contact us to fill out an application. We also offer workforce readiness programs for veterans, including a Success Readiness series, which features seminars and webinars on job seeking and life skills, as well as Incline Corps, a unique monthly fitness program exclusively for veterans. To learn more about Heidrea for Heroes or our programs, to watch a webinar, or to make a donation to support our work, please visit our website at www.heidreaforheroes.org. That's H-E-I-D-R-E-A, the number 4, H-E-R-O-E-S.org. Our veterans sacrificed a great deal to serve our country. It is our great honor to give back by lending a helping hand.
Hi, my name's Angela LaPerriere, and I am the Lending Officer and Business Assistance Manager here with SEED Corporation. SEED stands for Southeastern Economic Development Corporation. We are a certified development company, and we were established in 1982. We're an intermediary lender for the U.S. Small Business Administration. We make loans throughout Massachusetts and Rhode Island to both startup and existing businesses. We're here to provide financing when the bank cannot provide financing, either as a referral source or we can provide gap financing along with the bank as well. Today, my coworker Lindsay Williams is going to discuss understanding financial statements. I will turn it over to him now.
Hi, my name is Lindsay Williams. I'm the credit analyst here at SEED Corporation, and I'm going to talk to you today about financial statements and how they impact your business. To begin with, we're going to start looking at your personal financials and how your knowledge of your personal financials will help you in managing your business and your business financials. What can financial statements do? Financial statements can provide an indication of the value of your business. They can help you keep track of your income and expenses. They can reflect profits and losses. They can help you know when you can afford to borrow money. And they can provide you with a sales history for purchase of anticipating inventory and staffing needs. What financial statements cannot do? They cannot increase or create sales. They cannot keep your financial records. They cannot pay your bills. They can't pay your taxes. They can't collect accounts receivable or improve your bottom line. These are actions that you have to do as a small business owner. Financial statements are going to be tools that will help you manage your business and manage your financials, but paying your bills and making sure that things are happening in your business are actions that you have to take as a small business owner, not something that's going to be done automatically. Now, to gain a better understanding of how business financials work, we like to look at your personal household financials and what your personal household cash flow is. How do you determine what your personal cash flow is? You can take a look at your disposable income based on 12-month history. And you take your 12-month household income and you minus taxes paid. And then you minus all your living expenses for the year. And those living expenses include housing, food, recreation, transportation, clothing, utilities, medical care costs, all the expenses that your household incurs for a 12-month period, those are deducted from your income, and what's left is your disposable income. We also take a look at your personal assets. What are your personal assets? Those are things that your household owns of value. So you create a personal financial statement that lists all your assets as well as any liabilities or things that you owe, and what's left over is your personal net worth. Personal financial statement is going to reflect your personal assets and liabilities. It can be verified by a personal credit check. We'd look at your credit report, and that's going to indicate what your liabilities are. It's required for any application, whether through Seed or through a bank. They're going to require a personal financial statement, and it should be included as part of your business plan. So if you create a business plan as part of your loan application, and there should also be a personal financial statement. So what are assets? Assets are things that you own, particularly cash in the bank, savings accounts, IRAs, retirement accounts, accounts receivable, which might be loans you've made to friends and they owe you. That's considered a receivable. Stocks and bonds, real estate, automobiles, other personal assets. What are liabilities? Liabilities are accounts payable. That would be considered probably credit cards, notes payable to banks, so those would be short-term loans that you might have, installment accounts, which would be auto loans, maybe a loan on a boat, student debt, any loans you might have on a life insurance. There's certain life insurance policies that allow you to build up a cash value that you can borrow against. If you have a loan on that, that would be considered a liability. Mortgages you have, whether it be on your personal residence or on a vacation home or other property. Unpaid taxes, if you have either taxes that you pay quarterly, or if you have perhaps a tax settlement plan with the IRS, that would be considered a liability. And then any other liabilities. So if you have anything such as like contingent liabilities, if you've co-signed a loan or something like that, you'd want to note that. One of the other things we look at as part of the loan application is your business plan and how you've anticipated what your revenues are going to be in your business. And a big part of that is to determine pricing and what prices that you're going to charge for your product or service. A big part of that is determining accurate pricing that's going to cover your costs, both in terms of your cost of goods sold, but also which are your variable costs, but also your fixed costs. So if you don't price your product correctly and it's too low, it can cause your company to lose money, which would result in you going out of business. Or if your price is too high, that can scare customers away. So here you see underpricing can cause a business to fail. If products and services are drastically underpriced, the business will lose money and you'll ultimately shut down. Overpricing can have a negative effect as well, but instead of losing money on every sale, in this case, customers will shun your business and go to other places where they can get the same product for a lower price. So how do you determine the proper price to charge for your product? There's a number of different things that you can do. One of them is a customer survey. So you can go out and survey potential customers, either through the competition. You can talk to customers who are coming out of your competitor shops and just ask them, what do you think you'd be willing to pay for this particular product? You can shop your competition, so you could go inside your competitors and see what they charge for a similar product or service. You can do market research, so you can go online or go to the library and do some research on what typical prices are for a product in that given industry. And you also do what we call a break-even analysis, which will determine what the minimum price that you need to charge in order to cover your costs. One of the major expenses that you're going to have in your business is what's called cost of goods sold. This is known as a variable expense, and that's going to vary depending upon how much you sell, and it's going to be driven by your suppliers and what they're charging you for your materials. So what is cost of goods sold? These are the costs that are incurred in creating a product or service. They are directly related to your sales volume and should be controlled based upon your sales. So if you have more sales, your cost of goods sold are going to go up. If you have less sales, your cost of goods sold are going to go down. In operating your business, you also have fixed expenses. These are expenses that stay constant from month to month and do not depend on your sales volume. They're known also as operating expenses. You have to pay them every month regardless of what happens to your sales. Some of those include controllable expenses like advertising, payroll, and taxes, but most of the time it's things like rent or electricity, things that are going to be constant from month to month. Now, when you break down your income for the business, you look at it in terms of your gross income, which is the amount of money that comes into the business before any expenses are incurred. Then you have your gross profit, which is your gross income less your cost of goods sold, which is the cost for the materials or the service that you provide. And you're left with the pre-tax profit, which is your gross profit less your fixed expenses. So you have, up at the top, you have your income that's coming in, then you have your gross profit after your cost of goods sold, and then you have your pre-tax profit, which is what's left over after you've paid your operating expenses. We're going to talk a little bit about break-even. As I mentioned before, you're trying to determine what the minimum price that you can charge for your product that will cover all your expenses. This is very helpful in trying to forecast what your sales volume will need to be, as well as how much cash you'll need to operate your business. But a simple formula is to figure out break-even is gross income less cost of goods sold, which will equal your gross profit. And then your fixed expense, you take your fixed expenses, which you know are going to be the same from month to month, and you divide it by your gross profit, and that will give you what your break-even will be. And this is again going to help you determine what exactly the price that you've got to charge to cover all your expenses in a given month. Okay, one of the most important things that you can take away from this is cash flow and how important cash flow is to operating your business. Positive cash flow is achieved when money comes into your business faster than it goes out, and that's very important because if you have negative cash flow, you're going to very quickly have a problem. You need to maintain positive cash flow in order to cover all your expenses and pay your bills. And one of the key themes managing cash is timing. Positive cash flow is a matter of timing, determining when you have money coming into the business and when you're paying it out to pay various bills. Managing your cash flow is a matter of planning, and that's something that is very important to avoid having a cash crunch or being in a situation where you can't pay your bills and you need emergency financing or infusion of cash. Now remember, having cash is not the same thing as being profitable. That's a very important point because even if on your income statement you think you've turned a profit, that doesn't mean that you have positive cash flow. It just means that you have demonstrated a profit, but it doesn't mean that cash is positively coming into your business. Okay, don't let your business manage you. This is another key thing that comes down to planning. You need to plan in advance of what you're going to need in terms of managing your business to avoid any unexpected issues. And projections are a big part of that planning. Cash flow projections can help you anticipate how much money you'll need to cover your short months, which is very important because if you don't plan in advance, you're going to have a shortfall and you're not going to be able to pay all your bills or meet your payroll to pay your employees. Balance sheets are an important part of managing your business. And one of the things you want to understand is that a balance sheet, unlike an income statement, represents a picture of one day of your business. I like to say it's a financial snapshot of what your business looks like on a particular day, but it's really only a representation of one specific day, not a period of time. And what a balance sheet can tell you is what your business owns, the amount of debt that your business has, and the net worth of your business. And that's important because not only do you want to have a picture of that and what your business is worth, but you want to use it as a tool to manage your assets and liabilities and make sure that you're keeping them in balance and you're not taking on too much debt. All right, to break that down on a balance sheet, you have assets, which again are what you own, liabilities, which are what you owe, and the equity, or what is your net worth. And that's very similar to we talked earlier about your personal financials. Same concept of assets being what you own, liabilities what you owe, and what's left over is your net worth. And that's the same for your household balance sheet as well as for your business. And the formula for that is assets minus liabilities equals equity. So that's the same formula for your personal household as well as for the business. The income statement, on the other hand, does cover a period of time. It's not for one day, but for a period of time, whether it be 1 month, 3 months, or a year. And they like to say that that's a movie because that covers a period of time. It tells you if your business operated a profit or a loss during that specific period of time. And the main components, like we talked about earlier, are income, which is the revenue generated by your business, expenses, or the cost of your operations, and profit and loss, which is what's left over, or your profit from running the business. All right, an example to help understand these concepts is individual Mary. We're going to talk about some of the transactions that she experiences and how that impacts the balance sheet and the income statement. For example, Mary's take-home pay is $4,000 per month. Living expenses total $3,600 per month, and the difference between the two is $400. Now, Mary puts her monthly profit into a savings account. She buys a used car for $6,000. Then she puts $1,000 down for the car. She has an auto loan with a balance of $5,000. She buys a house, which she purchases for $300,000. She puts $30,000 down on the house, and she's left with a mortgage of $270,000. Now, how do these transactions impact her financial statements? This is her balance sheet. So you see here, she had $400 left over. That's right there. She had $6,000 for the car, the value of the car that's there, and $300,000 for the house. On the liability side, she had $270,000 in the mortgage for her house. She had a car loan of $5,000. And then down below in the equity, you see she has a home equity of $30,000. She has $1,000 of equity in the car, and she had a profit for that month of $400. So that leaves her with equity of $31,400. The main point here, though, is the total assets of $306,400 equals the total liabilities and equity of $306,400. So the balance sheet balances. But you can see how these transactions show up on her balance sheet. Again, so you see that the cash here, that was her income left over, was a $400. That shows up here under the assets. And then you also see that she bought a used car for $6,000. That also shows up on the assets right here. And the same is true for the liabilities. Sorry. She had a mortgage. She bought a house for $300,000. She put down $30,000. She had a mortgage for $270,000. That shows up right here. Her car loan right here. And then the equity that she has in each one of these individual things shows up under the equity section. Now this is Mary's income statement, which is also going to reflect those transactions. She had a $4,000 salary for the month. That shows up under income. And then it lists all her different expenses that she had for the month. And what's left over is the $400 that you saw earlier. That shows up as a profit on her income statement. That's basically how the income statement and the balance sheet work. In this case, we've shown for a household, but it's going to be a similar concepts for a business. All right. In conclusion, predicting the future is never easy. However, by following these do's and don'ts for financial protections, you can avoid making common mistakes. And that's important when you're trying to draw up financial projections or a business plan, is to try to avoid the typical mistakes and make your business plan stand out. So what are some of the do's and don'ts? Don't provide an income statement, don't provide only an income statement, include a balance sheet and cash flow statement too. Do provide monthly data for the upcoming year and annual data for the succeeding year. So you want to have projections that go out at least 2 or 3 years. Don't just do 1 year. Don't provide more than 3 years worth of projections unless your lender or investor asks for them. That's another key point. I mean, you really want to do probably 3 years would be ideal, but at least 1 or 2 years, and you don't need to go beyond 3 years. So some people might do 5 years. It's not really necessary because it's very difficult to predict the future, and the further you go out, the less reliable the prediction is. Don't provide more than 2 scenarios for your projections. You always want to do what's called a base case and then a downside scenario for your projections. So a base case is what you think is going to happen, and a downside is what you will happen in a worst case scenario. You do want to ensure the numbers reconcile. So you want to make sure that your income statement and balance sheet reconcile to each other, as well as a cash flow statement. You want to make sure that the cash flow does tie to your income statement. Don't be too optimistic about sales growth or gross or operating profit margins. That's another key point. You want to make sure that your margins are in line with the industry averages. And that's something that you can get online, or you could contact Seed and we have that information on hand here. But you want to make sure that your profit margins are not out of line with industry or with average for businesses in that area. And then do account for reasonable interest expense on your income statement. That's another key thing. You want to make sure that when you drop your projections that you account for any interest expense for money that you plan to borrow. Some people say that that's presumptuous, that you assume that you're going to be approved for the loan, but you have to account for the fact that you're going to spend money on interest expense, and that has to be built into your projections. Lenders know that you're looking to borrow money, and they want to make sure that that's been accounted for in your projections, because if it's not, then they have to be adjusted to reflect that. It's an expense that you're going to have to pay, and it has to be included. Okay, don't include every individual line item for each expense. When you're drawing up your projections, you don't have to have every small little item on there. You can, as you get into the smaller dollar amounts, you can lump them into a line item, miscellaneous expenses or other, but you don't need to have 100 different line items. As long as that miscellaneous line item covers the additional expenses, then that's perfectly acceptable to do that. And finally, you want to be as prepared and honest as you can be when you're meeting with a potential lender, because more often than not, you're going to be building a relationship with that person, and it's going to be helpful if you're starting on the right foot and being realistic with your expectations. And to a certain extent, that also goes to when you're making income projections. Even in your first year starting a business, if you're projecting a potential loss, that shows to your lender that you're being realistic about your expectations and not just imagining that you're going to have huge profits from day one. And that communicates a certain level of sincerity, but also understanding of what the real picture is going to be like. Well, that's all we have for today. Thanks for watching.